Full-service banking is dead, if it ever existed at all. That's according to Reuters Breakingviews editor Hugo Dixon, following the decision by UBS to pull out of fixed income. Well, Hugo joins me now. Hugo, let's talk about this then. The end of a cycle, effectively?
Yeah, I think you could. I mean, it's a super cycle in a way. This is what I call the myth of the full-service bank. Is one that the leaders of these banks have believed for a good quarter of a century. I would date it from at least the time of Big Bang in the UK in the mid-1980s. That was the idea that you needed to have an operation that was offering a full range of products in a full range of geographies across the world. And so that led to lots and lots of mergers. I mean, over 2.5 decades, plus hiring galore, pushing prices up, pushing salaries up. And that all sort of worked okay during the good times, but it has now left the industry with inflated costs, miserable returns, and they're having to redefine themselves. And this move by UBS last week was critical in that respect.
But you're also saying that the basic theory was largely flawed. I mean, the idea that a large corporation should go to one bank for everything doesn't really stand up.
Or a large investor, for that matter, to go to one bank for all of their trading in everything from equities through derivatives to fixed income, blah, blah, blah. Yes, that's the point I'm saying, is that it was largely flawed. I mean, I think at the margin, if you really have a great franchise and you can maybe extend that franchise over sort of new products and new geographies which are contingent to your areas of expertise. But what we saw during the upswing was lots of institutions that had no competitive advantage, really, trying to muscle into territories where there were other much more expert firms. And they could only manage to do this because, a rising tide lifts all boats.
Slightly inefficient, but what you're also saying that with this UBS move, that by shrinking the balance sheet, UBS could be allowed to maintain a lower capital ratio. So there are clear benefits of pulling back as well.
Well, that's right. I mean, you've got to remember they lost this. What they did, this big splurge into fixed income. They lost. I mean, it's difficult to count, but tens of billions of dollars of shareholders' money by that initiative. By pulling back, one thing is that they immediately release. Not immediately, because it takes a bit of time to run down this fixed income business that they're trying to sell down. But there's 14 billion Swiss francs of capital which are no longer needed for what's left of the investment bank. So that's quite a lot. But on top of that, the regulators in Switzerland, they put certain yardsticks for what your minimum capital has to be. And because they're going to be a smaller business, it's not just that they need less capital, but they need proportionately less capital, because the Swiss have taken the view that the bigger you are, the risk you are. And therefore they go immediately from 19% to 17.5%. I should say not immediately, once the thing is worked through the system. But there's even a chance that they'll become not only smaller, but simpler. And in the Swiss system, and indeed in systems elsewhere in the world, there is a view by regulators that the simpler you are, the less risky you are. And so again, they could get a further capital benefit.
So what you're also saying is that you're advocating that all the big banks should do something similar, but not exactly the same way. They shouldn't just hive off fixed income, but go back to what they were good at before.
That's right. And there will be maybe a few players, I should add. There may be a few players who can maintain something like a full service. But the idea that you needed a couple of dozen full-service firms operating globally is a nonsense. And one of the things that's happened, which is, so you'll see the other sort of second-tier players, a lot of pressure on the Deutsche Banks, the Barclays, the RBSs, to Credit Suisse to follow suit. When you look at, what's happened is that UBS is now trading at just over book value, which wouldn't be anything to crow about if it weren't for the fact that most of the industry is at a discount.
Yeah.
And so what that means is that the capital being deployed, the market doesn't believe that it's being deployed effectively. And so you're going to see, I think, increasing shareholder pressure on these other banks to follow suit.
Okay, so lots of interest to come in the next few months and indeed years from the banking sector, led by UBS. Okay, Hugo, thank you very much indeed for that. Thanks to Reuters Breakingviews editor Hugo Dixon. That's all from us for now. I'm Nigel Stevenson. This is Reuters.